U.S. stocks have handedly outperformed international investments over the past decade or more. Should you still hold international stocks or just shift or drift more towards U.S.? I've got that analysis and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Don't put all your eggs in one basket. But what if you don't like one of the baskets? Or what if you've had your eggs spread out in various baskets and one of them is just constantly lagging behind or falls to the ground? I don't know, you want me to continue with this analogy? That's sort of been the case with international investments. You've been told to diversify and not put all your eggs in one basket. That's the common phrase. And yet, depending on how long you've been investing, for most of the last 15 years, 10 years, U.S. investments have been the place to be. International investments have lagged behind. So is it time for a change? Are things different now? What should you do? Well, there's another saying about diversification. Yes, the don't put all your eggs in one basket. But there's another one. And this is the one that I like even more. And as I'm training our future and new financial advisors, I always go over this one. It's a quote by individual that actually wrote the book on asset allocation, so how to invest dollars. And he says, does diversification work? Yes. Will you like it? No. So it speaks to this point that in order for diversification to actually work, not all of your investments are going to be moving in the same direction, which means at all times, you're going to be happy with some of your investments and disappointed with others. But you've got to stick with it because over the long term, all the math suggests diversification does work. Having good investments that are cyclical in nature, but cyclical at different times, that is diversification. And as an investment strategy, unless you have some corner on how the world is going to move and what the future holds, diversification is a very prudent investment strategy for the core of your overall investment portfolio. But there's always going to be components, always going to be pieces that you don't like. Okay, with that backdrop, let's take a fresh look at international investments because I've been in this business for 20 some years. The first chunk was one story, the lost decade, if you will, the tech bubble, and then the great financial crisis. But really for the past decade, almost 15 years, U.S. investments have handedly outperformed international. I mean, take a look at a couple of these data points. This chart here is showing the S&P 500, so large U.S. stocks, not small cap, not the entire stock market, the 500 largest U.S. stocks, that's in orange. And in the purple or the blue is the Morgan Stanley Composite Index, the international index, okay? You can see since 2010, it hasn't even been close. U.S. investments in orange have significantly outperformed over that time period, essentially 3-to-1, 3 times the performance. Have they both had their ups and downs? Absolutely. But U.S. investments handedly have outperformed. Now, I want to jump forward to another slide here. This is one of my favorite slides, and it actually draws the conclusion that I want to make anyway. So there's no sitting on the edge of your seat, but take a look at this chart here, and what it shows is the time periods where international investments are outperforming U.S. investments or U.S. investments outperforming international. And the takeaway is going to be that they go in cycles. Case in point, the benefits of diversification. But take a look at the most recent cycle. That recent gray chart, or at the end of the chart, 14 years of outperformance where U.S. investments have outperformed international investments. 14 years, and like I said, by almost 3 times. The length of time of this outperformance, it's been the longest period of outperformance since 1970. Why 1970? Well, that's when we began getting data on international investments. And so were they around before then? Yes, but did we have the internet and was information readily available and reliable? No. So going back to 1970, that's when we have data towards. So this is the longest stretch of outperformance in any of these periods. However, it's not the greatest extent of outperformance. Take a look at that purple chart back in the second half of the 80s, where international investments in just 5 years, 5.6 years, 3 times the U.S. performance. So you can see it's cyclical and goes back and forth. But again, the question is this time different because we've had such a long stretch, 14 years of outperformance? Guys, it's very possible this time is different, but I wouldn't put all my chips on that. If you look back through history, as that chart just showed, but as these two others show, it's cyclical. It is cyclical. There are times where international investments outperform U.S., and that can happen for several years, even a decade. And then there are times where U.S. investments outperform international. The same would be said between large cap stocks and small cap stocks. The same would be said with real estate and the stock market. The same would be said with bonds and stocks. There are time periods where one is outperforming the others, and maybe that one is outperforming the other because of certain distinct characteristics of that time period, of what's happening in the world. And so we've seen that recently, but take a look at these two charts where it shows pockets of time where U.S. and international investments go in and out of favor compared to each other. In fact, if you look at all of the data, cumulative, since 1970 until now, U.S. investments have averaged about 10.5% rate of return per year. That's fantastic, and that's actually good news, especially for all of us that are waiting sort of impatiently for the stock market to start behaving again and recover following the turmoil in 2022. But compare that 10.5% to what international investments have done on average per year since then. Pretty close. Yes, the U.S. has outperformed, but pretty close. Not a landslide by any means. Therefore, I don't know the future, you don't either, but I would continue to hold international investments as part of your overall diversified portfolio. Now, what percentage? Should it be 50%? I hear some financial advisors say that when you look at the global economy, the U.S. economy is about half of it, and half of the total market cap, and international investments are the other half. Therefore, it should be split 50-50. There's recency bias. You also have to contend with that. The largest and best U.S. companies, they are global companies, and so I would overweight U.S., but I wouldn't abandon international investments. And that's because these are two areas that are cyclical, and they've shown over time that one will outperform during a certain period of time and then vice versa and go back and forth. And yes, we've been in a very long stretch, the longest stretch, where the U.S. has outperformed, but I wouldn't abandon international completely. The second reason why I would tell you, no, stick with that diversification is it's very possible. I'm hearing more and more pundits or financial individuals, experts, self-professed experts, say that the conditions appear similar to the start of the last lost decade. And during that lost decade, holding large U.S. stocks, the S&P 500, you went up, down, back up and down again, and you had a 10-year time period where your investment return was negative in large cap. However, small cap, international investments were volatile during that same time because we had two of the most extreme market environments that we've seen since the Great Depression. However, holding small cap and international investments, they did much better than large cap, and many people are saying that conditions are similar and are ripe for that could happen again. One point that I would speak to is valuations matter. What you're investing in, what's currently being projected and built into valuations, it matters. Take a look right here at this chart and what it shows. I know there's a lot of information on here, but if you look at the far right, U.S. large cap stocks. Now, in green, that diamond of 1.5, that was the valuation. Compared to average, okay, at the end of 2021. So right as the market was turning over and was falling off of its all-time highs. 1.5. So it was 1.5 times the actual average. So overvalued or expensive. We'll look at it today. It's come down significantly, but we wouldn't say that the U.S. stock market is cheap, right? It's still trading above average valuations, and by valuations, those are forward projected price to earnings ratios. So that's large cap stocks. Now go over to the left a little bit and DM equity ex-US. So that's developed markets, so established markets, but not including the US. Well, at the end of 2021, when yes, everything started to kind of turn over and fall down, were international investments overvalued? Not compared to their historical levels, not compared to the last 25 years. They were just about trading at the average level. And then where are they now? You could make a case that they're actually cheap relative to their 25-year overall price to earnings ratio. Same with emerging markets, EM equity. You can see that was priced a little bit above average. Currently, it's valued a little bit, priced a little bit below average. Therefore, I don't know the future. You don't either. This 14 years of outperformance from the U.S. could continue for another 14 years. We don't know. However, history suggests there is a case that over certain periods of time, you're really going to like your U.S. investments, not your international, and then it will swap and you'll like your international investments and not like your U.S. I've actually, my entire career, I've been in both environments where I've talked to people and we've reviewed performance and they don't want to hold their U.S. investments, they just want international. And I've certainly experienced the last 12 years or so when people have wondered, should we still have these international investments? Guys, history suggests that you should. In fact, based on valuations, it might be time for international investments to start improving. Work with your certified financial planner. Make sure you're doing comprehensive financial planning so you've got an investment strategy that's appropriate for your entire financial life. And then yes, that you're using multiple investment strategies with the base being diversification, holding both U.S. high quality and low cost U.S. and international stocks and bonds. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.